Hello, everyone, and welcome back to this episode of the Rose and Rubini podcast. Happy New Year! This time we bring you sort of a double episode of the last 2 weeks' coverage of the weekly column. My name is Manas Chavla, and I'm delighted to be joined by Brunello Rosa, CEO and head of research. We're taking a very broad macroeconomic outlook, and we're discussing that for the upcoming year because there's lots of concerning things going on in sort of the major Western economies. And we've touched upon some of these themes quite briefly in the past, but we hope to sort of make a bit of a deep dive into this. Brunello, you start off this week's newsletter by saying, 2023 will likely be a year of stagflation from a macroeconomic perspective. Let's just jump right into that. What does that mean, and what does that say about the risk of recession for major and Western economies?
Yeah, I mean, Happy New Year, of course, and this is going to be quite complicated here, as the IMF chiefs recently said. The IMF warns that one-third of the global economy might end up in a recession this year, with inflation remaining elevated, even if potentially peaking and start declining, but would remain elevated. This is effectively the definition of stagflation, a sort of stagnation combined with still persistent inflation. And this stagnation might actually end up being a contraction, so a proper recession. We'll see during the year how things evolve. Clearly, there are elements that are typically stagflationary, such as certain types of war. And the war in Ukraine is one of them because it creates issues to supply while creating a shortage of some important inputs, thus effectively implying higher prices for them. Hence, this shock is stagflationary. But also what we see happening in China in terms of COVID tends to be stagflationary because there would be spending to solve the crisis. At the same time, there would be further, most likely, restrictions, potential closures, other lockdowns, as the number of cases is increasing again. Lots of countries are introducing travel restrictions to Chinese people and eventually would be workers and so on. So this is another stagflationary shock, and I can name others. So the idea is that inflation will remain elevated, even if potentially might be peaking, thanks in particular to the fall in energy prices that we have seen in the last few months. And effectively, some of these effects that we saw 1 year ago will be washed out of the calculation. So when you start doing the year-on-year calculation, some potential beneficial effect might be seen, but inflation will remain elevated at the same time. Growth will be subdued, if not zero or negative. And that's in a nutshell the definition of stagflation.
Right. And let's maybe sort of delve into that inflation aspect of it a little bit more because it seems to be the concept that's on everyone's tongue nowadays and is a major issue in sort of all the kind of major economies. Um, what currently would you say is driving inflation, and what's driving our inability to control it? And will those factors change in 2023?
So inflation has been initially led by some short-term effects, the reopening of the economy post-Brexit, post-pandemic, some important base effects. Then, of course, the increasing energy prices and supply bottlenecks persisting across the world. This was the initial driver of an inflation that most people, including central bankers, thought would be temporary. Instead, we wrote that that wouldn't be temporary, it would be persistent, if not permanent. That's too much, but most likely persistent, as it proved to be, as some of these shocks persisted, but also new shocks started to emerge, and that might be along the lines of some medium-term trend that would be quite relevant. Climate change and the fight to it being one. The a more equal distribution of income between labor and market and profits, so that we see all these strikes around the world. Here in the UK, they are on a daily basis for higher pays and better working conditions. So this is also inflationary. The technological transition that used to be deflationary, tech investment used to be the typical way of saving money. Nowadays is inflationary because catching up with the latest technologies, including AI and the likes, is super expensive. It's not enough to replace, say, two workers with one computer. It doesn't work like this anymore. You might need the computer, but then you need specialized workers to make it do the job that is needed. And therefore, that's costly. And there are other medium-term factors. So when you put all these things together, you understand that inflation might be falling from the double figure that we've seen so far, 10%, maybe 9%, 8%. Going back to 2 is going to be extremely hard. Now, for base effects, the ones that we discussed before, inflation might be falling like a stone if all things go right. But eventually we'll rise back to 2% and then beyond because these medium-term effects are still in place. In a worst-case scenario, instead, inflation is not going to drop like a stone. It's going to decline, but it's going to slowly try to approach a new normal. That is not going to be 2%. It's likely to be 3, 4, even 5%. So much higher than it used to be. And so there's even a debate on whether we should change inflation targets. And that's, a totally new debate that we can discuss it in future occasions.
Right. And this week you discussed the sort of two major kinds of decisions that governments will be forced to take, fiscal and monetary decisions. In the fiscal, quite interestingly, you outlined sort of, 5 different wars that governments almost had to fight, and you've touched upon some of these already. But broadly, what would you say are, the biggest decisions that governments could take on the fiscal front to, sort of credibly fight inflation, to control consumer investor expectations and sort of tame that beast?
So the major anti-cyclical decisions the governments will need to take are deciding whether they want to continue shielding corporates and households from high energy prices. Because let's not forget, if governments intervene and help out, so to speak, families and companies now, by definition, the inflation rate, the peak in inflation rate is going to be lower, exactly because the government is absorbing part of the excess. But by doing so, is effectively adopting an easing or easier, say, fiscal policy, loosening, effectively is injecting money to the economy. And that is inflationary per se. So while in the short term you might see a reduction in inflation, the fact that the government is intervening might prove to be inflationary down the line. So this is kind of the major anti-cyclical decision that governments will need to take. Then you mentioned the 5 wars, and as you said, some of them I've already mentioned, and on the tech transition, on the climate change transition, on the pandemics, on the redistribution of income, and then, of course, on the hot and cold wars that we see happening all the time, and therefore the military spending that is associated. These are the medium-term decisions the government will need to take, and most of them tend to be inflationary rather than deflationary.
I see. And if we look at sort of the monetary policy front, I mean, we discussed this recently, but in the last few years, we've seen an unusual synchronicity in the way that all the central banks raise rates together almost in the same week, or sometimes with the same margin. And I'm wondering if that's a trend that'll continue. Is there pressure on central banks to raise rates even further on the monetary front? Are they expected to? What do you think will happen there?
So, theoretically speaking, with inflation peaking, central banks could take a bit of a break and pause in the tightening cycle. So the real question is, will in fact inflation subside? If it does subside, then central banks will probably stop hiking rates. They will need to keep rates elevated for quite a considerable period of time, just to make sure that the economy continues cooling down. But if instead inflation proves to be stickier than expected, and central banks will need to increase even further interest rates, that will definitely cause some damage to economic activity, and therefore the recession will become almost inevitable, let alone if there's the chance that these higher rates will create financial instability episodes. Because if that occurs, then central banks will be kind of in a big dilemma. So would they prioritize financial stability or would they prioritize price stability? That's one of the dilemmas that we'll have to face. At the time in which you already have this conflict with fiscal policy as governments are spending somehow paradoxically to stop inflation from increasing, but by doing so, adopting inflationary measures, and central banks that are actually trying to stop inflation from increasing, but by doing so, they worsen economic activity, which is something the governments are trying to prevent. So there's clearly a conflict between these two sides of the policy equation, if you want, at this time, even disregarding all the other policy areas such as regulations and so on and so forth, which can further complicate the picture. So clearly, there's a situation that needs to be monitored very closely, and this is what we intend to do during 2023.
Absolutely. And the sort of tension between fiscal and monetary policy, I mean, it's happened before, of course, but it'll be a central theme in this year. But I'm also, I mean, I was looking at the political calendar for this year, and there's plenty of, really important elections coming up, and that often has interesting trends with government spending, with obviously the US and the UK ramping up, but also in Russia and Ukraine. And, kind of based off of that, but based off of also this tension between fiscal and monetary policy, what are the implications for markets?
Markets will be very volatile this year, we believe, because they will have to follow the news coming from the policy front and in the macro front. It's going to be very hard for them not to do so. In the global outlook that we had published at the end of last year, we discussed several scenarios, of course, depending on what the macro does and what policy response you observe. But in a nutshell, and just simplifying things for the sake of this podcast, we think that equities will remain under stress because if inflation proves stickier than currently thought, the central banks will need to keep the policy tighter than people currently expect. That is going to have a detrimental effect on equity valuations. In terms of government bond yields, clearly we should discuss about major jurisdiction, Eurozone, core and periphery, and emerging markets, and so on and so forth. But just to stay at the highest level of, say, the year's curve, short-term rates are meant to remain quite high and possibly increase it further. The long-term end of the yield curve would crucially depend on what the inflation does and what the economy does. In a stagflationary scenario in which inflation remains sticky and the economy instead goes into a recession, probably long-term yields will remain around current levels, potentially increasing a bit further if the inflation component becomes stronger than the growth component. That's just the US and to some extent the UK and maybe Germany, but of course for the periphery of the Eurozone is going to be very different. There is an entire debate on what's going to happen to the yields of BTPs, for example, in Italy, and whether Italy will need to activate the TPI from the ECB. And in terms of currencies, we saw the strong dollars of the last few years. Perhaps it's time for the dollar to take a bit of respite as other central banks catch up with the Fed in terms of policy tightening. This is in a nutshell what we expect of the major markets and other the alternative markets. somehow called alternatives. So equity, real estate, cryptos, and so on. We think will take, unfortunately, is still a year of passion for them in the sense that it's going to be quite complicated for them to perform well. Instead, we think that investments in digital infrastructure will continue to do pretty well because that's a theme that is, how can I say, medium term is not going to change. Whether you have a recession or recession, inflation or inflation, it is kind of place to be at the moment.
Yeah. It's interesting to me how, we have these sort of short-term trends and long-term trends operating in parallel, and there's an interplay between them. We talk about the climate transition, the sort of, broader labor market transition with the introduction of AI and technology and jobs. All of these factors, with events like, say the Russian-Ukrainian war really accelerated almost the climate transition by introducing us to natural gas, and then making us a lot more comfortable with it. Likewise with the sort of the automation front, there's major developments there. And I think often, we kind of forget that these short-term and long-term, consequences are linked that intricately. But inflation and, policy rates certainly have massive impacts on that. And so even if we don't see the consequences of that in the short term, we certainly will, possibly years down the line. But definitely something we'll continue to follow as it'll dominate, all the headlines this year. Ready to kick it off this year with this. Thank you so much for your time and insight, Brunello.
Thank you very much. Until next time, happy New Year again.